problem with that? If you have, shout. And then we'll put this recording on the Resourcefully blog page, so if you need anything, you can review it. Right, over to you, Sean, and I'll switch my camera off and focus on you.
Sure. Well, hey, look, obviously appreciate the introduction. Yeah, as Pete said, I helped Pete with his transfer of the UK pension here to New Zealand. Obviously, what I want to cover off today is a little bit more expansive on that. So really want to talk about KiwiSaver as a whole. A lot of people don't realise how beneficial it can be, especially people in your position where you guys are as such contractors. A lot of the time, KiwiSavers do get kind of put to one side. So very much want to talk about pros and cons around that, the tax advantages of a KiwiSaver as well. I'd like to talk about the UK side of things. Obviously, it's a big part of my role as an advisor. So I help people look at options of having their pensions in the UK and restructuring them, or potentially bringing them here to New Zealand like we did with Pete. And then I'm also going to introduce you guys to a tool. And this tool is very much around retirement planning, which is a big focus of our business as a whole. So it's bringing all of these different assets together, like KiwiSaver, pensions, Australian supers, etc., and actually, building a plan around those and saying, right, well, hey, look, I want to retire at some point. What age is that, and what sort of income do I really want in that retirement? If any of you guys are interested in that tool, obviously after today, I was going to give access to that tool for anybody that wants it, with the idea that if you want to dive into it yourself, more than welcome to, but obviously I can also help you with it as well, and we can help build that plan if you did want to go down that track. So I very much want to just sort of start with KiwiSaver, and I think that's to do with the fact that it's very common when I talk to someone in a similar position to yourselves, like I said, contractors. KiwiSaver does very much get left to one side. A lot of people kind of assume, on the basis that KiwiSaver has basically money locked away, and you chuck money into it and you never see it again, and that's kind of it. KiwiSaver was actually a government initiative on the basis that they wanted people to save for retirement, and the idea behind it is the government are leaning towards the fact that there's going to be a lot less ability to pay things like government superannuations in the future, and it's very much to do with the fact that we are technically a declining population, and the way that the way that government superannuations work is they are funded by the people below. So when you have an aging population and less people to fund it, it becomes quite a big issue. So there's a big drive in a lot of places to help obviously save for that retirement and obviously be a bit more self-sufficient. What a lot of people don't realize is everybody who has a KiwiSaver pay a fee. So ranges between companies, it's usually around either about 0.9 up to about 1.5, depending on who you're with. And what a lot of people don't realize is part of that fee is actually designated towards an advisor. So you're paying for advice if you have a KiwiSaver, but so many people I talk to, when we had these initial conversations, aren't getting it. And the idea being is typically if you're put in by one of the default providers with the idea that you've just been set up and you don't know much about it. The only time you ever hear from that provider is basically sort of your annual statement. Okay. KiwiSaver is actually quite an efficient way to save for retirement. And the reason behind it is, firstly, obviously, you guys contribute to something and it's growing in using the markets to obviously grow as well. So it's not just sitting there in cash, it's actually working for us. A few ups and downs along the way, as we probably all know from the last year. It's been a little bit tougher than usual, but long-term gains have been often quite consistent, when we look at history. And very much in the sense that you basically, when you're paying into your KiwiSaver, the government will actually pay you 50 cents on the dollar up to $1,042 a year. So a lot of people I talk to, obviously, they want to keep cash flow moving and obviously make sure that they've got available cash. And in those situations, I often talk to people and say, hey, look, if you're really wanting to keep as much cash aside as possible, the only thing I would be suggesting you do is you at least pay in the minimum. And the minimum, as I said, is $1,042 a year. And the government will give you $521 a year for free. Okay, so if you actually break that down, it's a 50% return on what you've put in. And you're not going to find a return like that anywhere else, right? That's amazing in the grand scheme of things. The other side of it is in the sense of it's not just for retirement. Okay, you can use your KiwiSaver for first homes. So if you're in a position where you haven't bought yet, or if you had bought overseas, you've sold everything and you've moved to New Zealand, and you are in a position where by contributing to KiwiSaver, and sorry, it's just got a question come through. Apologies.
Sorry, no, that's me just putting bits that you said to in capture.
Oh, okay. Sorry, apologies for that.
I'll call out the questions. You carry on.
That's all good. So yeah, it's not just around retirement. It's able to be used for a first home. And if you can show you're back in a position as a first home buyer, you can also use your KiwiSaver in that scenario as well. So a lot of people I talk to who have sold up everything over in the UK, they have come over here and often been able to use that KiwiSaver to purchase in New Zealand. The other side of it is it's also actually available for financial hardship. So if there's ever a situation where you guys do fall into a bit of strife and you can prove financial hardship, which is obviously a reduction of income by more than 30%, you can actually use that KiwiSaver to help yourself and get yourself out of that position as well. So there is a little bit more flexibility than a lot of people actually believe. And the idea behind it is very much about something that you do tuck away and obviously do focus on retirement. But there can be aspects where you can actually get access to it and use it for personal reasons as well. Now, the KiwiSaver side of things is especially great for everybody in general, but the other side of it is actually around kids. Now, some of you might have kids, some of you might not, but there's a huge difference between obviously the time that you start investing money and what the end result is. So just to give you a little bit of an example in terms of just very basic numbers, if you were to be in a position where your child was born and you contributed $5,000 into a fund for them, and you put it into a growth fund, and a growth fund is expected to do at least 7% or more per annum, and that's sort of a conservative number based on history. If you left that invested and only paid in the bare minimum, which is that $1,042 a year, it means that the end result at the age of 65 is your child would have a little over $1.6 million. If you do that in comparison, and you obviously start that when a kid would typically start KiwiSaver, which is when they join the workforce, quite often around sort of maybe 16, they're getting a sort of summer job. In that situation, obviously, it's only about 50 years worth. The difference between is actually an end balance of 580. Okay, and that's starting with the same outlines and same concepts. So basically, only taking 15 years away, obviously thirds roughly what they can actually end up in retirement. So the longer that you can be invested, the greater the opportunity for the end result. So KiwiSaver as a whole, really good. A lot of people also don't realize that not all KiwiSaver providers are the same. So essentially, a lot of providers out there are very good at certain aspects. Some are very good high growth funds. Some are very much focused around conservative, your retirement style funds, lifestyle funds, and others are typically focused around your ethical and ESG funds as well. So depending on a person's appetite for risk, what their persona is, and obviously how guided they are towards either being ethical or not so much, and whatever that might be, they are in a position where they can actually control how their investments are invested in what markets. So a lot of people don't realize that, and they just assume that who they got put with is who their provider is. And lastly, the other thing is a lot of people don't realize that there are 5 default providers in New Zealand. So when someone joins the workforce, they're automatically enrolled with one of those 5 providers. Just because they're a default provider doesn't actually mean that they're one of the best providers out there. Okay, a lot of them are banks, and nothing against banks in general, but although they're big, it doesn't necessarily make them the best. Very much you're often treated as a bit of a cog in a wheel, and as I said, you get very little advice. You're very much expected to reach out to them if you want any help with your KiwiSaver as a whole. So that in a nutshell is a very much around, I guess, an overview of KiwiSaver, obviously how it can affect you and time investing in the market. and also the fact that you can get free money from the government. And at the end of the day, why not? Free money from government and free advice. You know, you're entitled to that advice. It's built into what you pay already. So the next thing I really wanted to cover off was a little bit about pensions. I'm just going to share my screen with you very quickly because there's a table that I can take you through just to give you a bit of an idea of what it looks like. So this is something that that Pete and I talked about when we talked about his pension. So I know this might not be relevant for everybody, but as you can imagine, it's a big part of what we do, being a UK company. But a lot of people, you know, have UK friends and all that sort of thing. So basically, with UK pensions, the way they work is when people pay into them, they're exempt from tax on the way in, they're exempt from tax on growth, but then they're taxed on the withdrawals they make. So a very clever way of doing things. They obviously leave it alone when it's small, tax you when it's at its largest. So yeah, know how to do it. Full access to your UK pensions is typically 55 if it's a personal pension. And when you access that money, you get 25% of it tax-free, and the remaining 75% is taxed at your marginal rate, which is obviously this side over here. If you leave your pension in the UK, what happens in that situation is your pension is treated as what's called a foreign superannuation. And it means that 100% of the pension becomes taxable. And for most people, that's usually around 33%. So very, very heavy on tax in the UK. Not only that, but if you were to pass away, they also have tax on death in the UK. So what that entails is if you were to pass away, before that money is passed on to your loved ones, there can actually be a tax of up to 45%. And then finally, as you can imagine, your money's in pounds. So every time that you withdraw money, you're going to have to deal with the exchange rate, bank transfer fees, spreads on currencies, etc. So that very much brings on why a lot of people look at bringing their UK pensions over here to New Zealand if they're intending to stay here. So if you bring them here to New Zealand, you transfer them into what they call a KiwiSaver. And a KiwiSaver stands for a Qualified Recognised Overseas Pension Scheme. And all it is a facility the HMRC have approved that allows to transfer a pension overseas. Now, in New Zealand, our KiwiSaver work quite similar to the way a KiwiSaver works in the way that they're taxed. So here in New Zealand, when we bring money over, usually it's taxed on the way in, marginally on the growth, but then when we reach retirement age, we're then completely exempt from tax. So the idea being is think about it like a bank statement. What you see is what you have. And when you draw down on that money, there's no income tax to pay on withdrawals. There's no tax on death in New Zealand. So 100% of that money is passed on to your preferred beneficiary. You still get access at 55, so you don't have to wait to that 65 mark like KiwiSaver. And we also have multi-currency options. So rather than bringing the money straight into New Zealand dollars, we can actually bring it over in pounds and invest it in pounds, and then switch it into New Zealand dollars when we're ready to do so. So that, in a nutshell, is the way that New Zealand works and why a lot of people look at bringing it over here. The other side of it, as I said at the very beginning, is in New Zealand, we're taxed on the way in. However, if you move a pension within 4 years of moving to New Zealand, you can move a pension completely tax-free. So the idea being is you paid no tax on that lump sum in the UK, you would pay no tax on entry here to New Zealand, you would only pay tax on the growth you make. And just in relation to the way that KiwiSaver and KiwiSaver work in a similar way, your KiwiSaver and a KiwiSaver are a pie fund. So rather than actually being taxed at your marginal rate, typically probably 33 or even 39% for some of you, it's actually it would only be taxed at 17.5 or 28%, depending on your income. So it means that obviously it's more tax efficient being a pie fund, and what that means is people are collecting money all in one place to create a more tax efficient approach to investments. So that's the core difference between the two. If you do move into year 5, it's not actually the end of the world. What happens is you move on to what they call the schedule method. And what that means is in year 5, a portion of your pension becomes taxable. And every year you wait, that portion grows slightly. So the idea being is if you transfer it here sooner rather than later, the more tax efficient it's going to be as a whole. So just unshare that one. So basically, those are two of the core parts of our business as a whole and how we work, and basically in the sense of the pros and cons of the KiwiSavers and the UK pensions. The next thing that we really do is very much tie everything together, and this is the tool that I was talking about that I'm going to be sharing with everybody in the sense that if they want access to it, they can do so. So I've created a bit of a mock person using my own details. Hope everybody can see that. But basically, this tool is called Planalytics, and Planalytics is, as I said, a retirement planning tool. And it looks at two core aspects in life. It looks at how quickly you can pay off your mortgage, and also how your income looks like in retirement. Obviously, as you grow your money between now and 60 or 65 or whenever it might be, and what it looks like as you are no longer working and taking that money. And the reason we look at that is very much in the sense of, you know, in life, we've got sort of four key elements to finance as a whole. You've got your income, which is where a lot of your cash comes from in your life. You've got your property, which is your capital asset. You've got a safety net, which is obviously your emergency funds. And then we have what's called your wealth account. And your wealth account is very much made up of your KiwiSavers, your investments, your capital and your property, etc. And that's what's going to pay you an income when you reach retirement. And that obviously plays a massive factor in obviously people's decisions and how much they want to take in retirement. So basically, just as a very quick overview in the way that this works, what you do is you take out what you have in existence. So you talk about obviously your existing properties. I'm just putting random information in here. Obviously your assets is cars, your KiwiSavers, okay? And you can play around with this in the sense that basically you can change your contribution levels and you can change the graph and show what it looks like in the long run. So as an example, you know, at the moment, we can see here that based on how much I'm contributing and my income, my expected end result is about 1.2 million, okay? If I was to change this to 10% as an example, what that means is obviously increasing your contributions. It does take a second to load up, but basically we're in a situation where all of a sudden we're now at 2.3 million in terms of a difference. So it just shows you how you can change your retirement as a whole. Bring that back to 3% just for today. Obviously, you include your savings and investments, so any investments you guys have separately, and it's going to track out what your mortgage payments look like and your lifetime cash flow, as I said. It can incorporate essentially anything. So it can incorporate future purchases. It can incorporate obviously your existing property, renovations, first home purchases. It can also include things like kids, what your education fund's going to look like, how much you're putting aside for holidays every year. So an amazing tool, and it also can cover where your gaps are. Basically, the end result of these two graphs where it shows you, firstly, what you look like if you pay off your mortgage naturally. So what I've done here is say, okay, after about 10 years, I'm going to do some renovations, fix the roof or whatever it might be. And obviously, I want to pay my mortgage off in the next 28 years. You then have a dark gray line, which shows what's called the accelerated version. All right. And the accelerated version is if you're using your excess cash or your surplus cash, how quickly could you technically pay off your mortgage? So based on what I want to do in this scenario, essentially shows that I can pay off my mortgage in 15 years if I nailed down and cracked into it. On the other side here, it shows you what our lifetime cash flow looks like. So it shows all of the changes in our lifestyle. So for the first few years, obviously all the money is going towards the mortgage. We're then saving that money, and then we get spiked. So at 60, I've got some investments that are cashing out, continue to grow because we continue to work. Then we get our KiwiSavers, and then it shows you what it looks like in retirement. So what I've got here is I've got an income of 150 from 60 onwards, and then obviously reducing that to 100 from 80 onwards. So really a very clear way of just visually seeing how things are tracking for yourself, for your family, and obviously you can also incorporate things like your insurances as well. So am I protected, correctly for my situation in terms of what I have as assets at the moment? If I was to pass away, what would my partner do, or what would my kids do, etc. So really clear way of obviously identifying those gaps, and then what we do is obviously help you work to fix those gaps as a whole. So I guess in a nutshell, that is an overview of KiwiSaver, obviously the UK pension side of things, and the retirement planning tool that we can help people with. We can also help people with Australian supers. You can move your Australian super directly into your KiwiSaver. It's a very easy process. It just takes a little while, which is great. So yeah, obviously there's ways to, if you've worked overseas in the past and you want to look at getting your money here to New Zealand, there's lots of ways that we can go about that. Any questions?
I just realized that I'm poor. So allow me to go cry into my coffee quickly.
Look, it's amazing when you actually start breaking it down. You know, how the situation isn't as often as bad as you think. You know, in terms of the time that you have and the ability to use compounding interest. So, you know, a lot of people I talk to that are in their 30s and 40s, you know, that's the time that they quite often start thinking about these things. You know, even getting into your 50s and the kids start to move out. It's these life events that quite often happen, you know, that are going to cause people to start thinking about it. The sooner you can think about it, the more chance you have of rectifying the issue. Because as I said, you know, you're starting at birth versus 15 years later, 20 years later. It just means that it's doable, but it just obviously makes it a lot harder because you got a shorter period of time to actually work with.
I think for me, the information was quite valid and I really liked it. Coming from South Africa about 5 years ago, we had everything quite well planned then. We had investment accounts, and because the interest rate is so high over there, there were quite a lot of opportunities to invest money.
Yeah.
And you'd have wonderful return on investment. And then when we came over here, we found that getting or investing your money wasn't as easy as it is in South Africa. Like people looked at us weird when we asked, you know, what's your investment portfolio look like? They're like, what's that? And everyone was just speaking about KiwiSaver. So that's kind of where we are now. So we've sort of almost defaulted in just putting money away ourselves with slightly above average KiwiSaver contributions, which is set about 3%. When we were permanent employees. Now, the one question that I do have that might be relevant to us as contractors, I'm going to ask that as a newbie contractor. It could be helpful to someone else. I've moved from permanent employment, where I had a scheme partner at Mercer, I think is the one for KiwiSaver that we were with. And when I left my permanent employment and became a contractor, I no longer have those automatic deductions going into my KiwiSaver. And I feel like a lot of people at that point stop paying KiwiSaver because now it's, so how do we, and someone like me who would very much like to keep contributing to my KiwiSaver, even in its very minimalist form, how do we go about paying manually into our KiwiSaver accounts?
Of course. So there's two ways you can go about that. Obviously, every provider is going to have these options for you. So you have a typical direct debit, and basically in that situation, you would contact usually your advisor, and they would provide you with a direct debit form to fill out, obviously, the amount, what date, and the frequency that you want. Most providers, at least over 90% of providers, will actually also allow you to set up an AP, an automatic payment from your personal bank account. So what you can do is you can actually go online. Companies like Booster and Milford, who are typically, you know, some of the larger companies in New Zealand, you can just type their name in, and it will literally pop up just like you would with any other major company. If not, obviously there's basically usually there'll be a section on their website where it will provide you the banking details that you can set up an automatic payment into the account. If you're going to go down that track, my first suggestion is just make sure you review it against the market. Mercer have gone through a major overhaul at the moment. I don't know if you've been privy to the information they've been sending out, but basically, you know, they had a bit of an issue last year, and they've obviously rectified all of that, but they're doing a big overhaul in that regard. So it's very much just about reviewing the situation, making sure you're in the right fund for you and your situation now, and then setting up all those payments initially. And what I usually say to people is, you know, what you've done is fantastic, and the fact that you've set up something side by side with KiwiSaver, because KiwiSaver is amazing, but it does have its restrictions in the sense that it is retirement, first home, or hardship, and you want to have something as an emergency fund as well. It's your safety net, which sounds like you're building at the moment. But the idea being is when I say to people, I say choose what you're going to pay into KiwiSaver up to 3%. If you're willing to contribute more than that to KiwiSaver, the extra that you're willing to contribute should go into something as a side pot. It's set up in a similar way to KiwiSaver, so it's still a pie fund. It's still tax efficient. It's still very low cost. But if, excuse my language, but shit hit the fan, then you're in a position where you can actually draw on that money within 5 working days, rather than obviously having to go through the process of proving financial hardship.
That's golden, mate. That is perfect. Yeah, 100%.
Sure.
I agree. Awesome. Thank you.
No, you're welcome. You're welcome. I saw a message in the group chat just from Carl. In terms of the tool, so this is a tool that we've bought the license for. So basically, if anybody wants access to it, please just contact me. And basically what I'll do is I'll get you, all I need is your name and your email address, and I can get you set up with an account. You'll get an email from Planalytics directly, and it will give you access. So as I said to Pete, anybody here today or anybody part of Resourcefully will have access to that. Anybody who has any connections to the UK, whether it's themselves or a friend, will do deductions and fees for their pension transfer. So usually it's 5% transfer fee, but we don't charge other things like broker fees and exchange rate fees and exit fees. We have one fee, that's it. We'll do it for 3% for anybody connected to Resourcefully as well.
Sure. Just on the tool, it looked quite technical. Could we get ourselves in a bit of a mess, or do we need to really sit down with you to start with and work some things through and then tweak from that point? Is that a better way of doing it?
No, look, I'm going to be honest in a sense. If you just let me share my screen very quickly again. So basically,
I could put all sorts of crap in there and realize I could retire in 10 minutes and not really.
Yeah. So look, it's very intuitive in the sense that as you start to follow it, it gives you a lot of guidance. So on the left-hand side here, you've got your tabs essentially, and you can imagine it goes in order. It's your information, your assets, your liabilities, your income, and your expenses, right? Those are your core areas that most people follow. So you start at the top and you work your way down. And basically, if you're ever stuck somewhere, you'll see these little icons that are little I, information, and it will explain what's supposed to go in there. So it actually gives you a breakdown of every section. You'll see them everywhere. If you're really stuck, there's even videos that are connected to this as well. So really, really helpful in providing information. If there was ever a situation where you were stuck, obviously anybody that's on this tool could always contact me. I would be happy to do a sit down with them. We use this as an introduction for people because a lot of people don't realize where they stand. So for us, we can actually show them how everything looks. We can identify gaps for them and say, hey, look, these are the areas that are of a concern. If you'd like help with them, we can provide advice on those and talk through obviously how that works. But at the end of the day, we'd always help you get this right initially, because this is a very clear way of showing where people's shortfalls are or where they're doing well. A lot of people want to look at things like, hey, I want to leave something behind for the kids. How do we go about that as well? So we can obviously identify that at certain stages and using life expectancies, etc.
Cool. The other one was you talked about kids and putting something away for them and doing a sort of kids KiwiSaver. Can you do that for partners as well, or is it just sibling sort of kids that you can set up for?
Yeah, so basically anybody can get themselves set up. In the sense of that, even if they're set up, someone else can technically pay into that pot for them. It doesn't have to come from them personally, especially if they're a contractor. So I've got a few clients where there's a stay-at-home parent, so obviously they're not working. So what happens is the partner contributes roughly what would be 3% of their previous income to their KiwiSaver, or a set amount that they've chosen. There's no limitations around that. In terms of kids, the one thing just to consider is the fact that if you are setting up your child, both parents have to sign off of it. So if you have mum and dad in the picture, then both of them would have to sign. But what happens is they are essentially the guardians of that KiwiSaver until the child turns 16 or starts work. Once they turn 16 or they start work, it essentially gets taken away from the parents' control and falls under the children. Investments are very similar. You can do a very similar setup where a lot of parents want to set up an investment fund. They might not want it for property or retirement. They might want it for education. So you set up a very similar style fund. And again, same concept. It's under the parents' control up until the age of 18, and then it gets passed on to the children. If you're doing it that way, the children, and you're setting up in the children's name, it's obviously taxed at the child's tax rate. So it'd be 10.5% instead of 28%, which is obviously what most of us would be.
And the other question I was going to ask, and it's just come from mind. Oh yeah, there's a date when you need to start. Well, there's a date
Yes.
each year, isn't it, to contribute to take that effect, I think. And what prompted me to have this with you is it's coming up at end of June. So if anybody wants to contribute and get the government portion put in, end of June is when they have to do that, and then they can do
Correct.
it again, obviously, next year.
Yeah, exactly. So 30th of June is the cutoff for each year for KiwiSaver as such. So as long as you pay in that $1,042 before that point, you're entitled to the full government super contribution. If you were paying half of it, obviously you would be entitled to half of it. So it is 50 cents on the dollar up to that amount.
Cool. And you can do that monthly, and they just work it out at the end of the year, do they? Yeah.
Yeah.
Okay.
I've got a client that pays at the end in June in one go each year. Basically, they just keep money aside for it. I've got people who pay weekly, so it's utterly up to the person and their discretion, because it allows a lot of people, especially people who sporadic incomes, is be in a position where they don't actually have to have a set amount. They can choose, obviously, the portions they're paying in as separate amounts.
Cool. So we got a couple of questions. So how are you going to share the platform? Are you just going to email out or put it in the chat? Or how do you want to do that?
So basically, if I put my email in the chat, if anybody wants access to it, please email me directly, and I can essentially get you guys set up. So I'll do that just before I leave now. I can see, oh, hang on, I'll do it actually, Sean. I can see another question just in regards to Australian super. Just let me type this, because I'm male and I can't do two things at once, as we all know. So basically, Australian supers are actually really simple in the fact that, because of the relationship we have with Australia, they treat KiwiSavers and Australian supers almost identically. So if you have an Australian super, you can transfer it directly into your KiwiSaver. As soon as you can, basically all I need to know in that situation is who your Australian super is with, and then I can request the correct forms, and it takes about 4 to 8 weeks, depending on communications between Australia and their existing fund. But the idea being is you submit the forms to your KiwiSaver provider here in New Zealand, and they actually do 90% of the work for you. So quite easy to do.
And one of the things I think you mentioned right at the beginning, and I think it's something that's really important and people don't grasp, is that percentage of your fee when you're paying into a KiwiSaver pays for an advisor. So that if anybody wanted to come to you, that's paid for by that contribution. Is that right?
Yeah. So people seem to think that you got to pay thousands of dollars to get advice. It's not, especially with KiwiSaver, it's not true. The idea being is if someone came to us and said, hey, look, we want help with our KiwiSaver, we will provide a recommendation with no upfront costs, with the idea that you become a client of DeVere's, as an example. It's same with any other advisor, around New Zealand, and we would get a portion of the fee that you already pay. So there's absolutely no additional cost to you. It's a win-win for advisors and clients. And the reason behind it is the FMA, which is the Financial Markets Authority in New Zealand, have had a huge drive towards, they want Kiwis to receive advice. And the reason behind that is there is a clear correlation between people getting advice and actually ending up with more money in the long run. And it's to do with the fact that they've actually got someone as a sounding board. That's really the nuts and bolts of it. It's someone that they can talk to without making a rash decision. COVID was a prime example of that. Big chunk of people moved their pensions or their KiwiSavers into conservative funds. And then when the markets took off all of a sudden, quite rapidly, it was much faster than everybody was expecting, they were in a position where their fund was only growing very slowly in comparison to what it would have done if they'd stayed in the fund that they were in. So they did what was called crystallize their position, and they lost out on all the gains that they would have made if they had just been patient. So it's it's very much about having a sounding board, someone you can speak to, someone that you can bounce ideas off, but also expand into other areas as well, through our side. Oh, bit late.
Yeah. And normally what we do only in the office, the last person in, we say you've got all the actions, but yeah, awesome.
Are there any other questions?
Yeah. Giles, you can just talk if you want rather than type if it's easier. what we'll do is I'll save this recording and put it on the Resourcefully blog page. So if anybody wants to see it and watch it again, they can. I think it has all the chat in there, I presume so. So you can get Sean's email, but I'll put that on the blog as well, just in case. And then you can get access to that tool, which looks brilliant.
Yeah, look, guys, please reach out if you guys want to have access to that tool. More than happy to share it because I absolutely love it myself. I use it for all my own stuff, and clients love it as well because it's just really easy to follow. Once you've had about 5 minutes on it, you realize it is not as complex as it might look.
Yeah, and you can save it and go back to it and tweak it and play.
100%. So it's a live site in the sense that you can have a base scenario and you can also create additional scenarios. So you can create different aspects of, hey, look, what if I was to retire at 55 instead of 65? How would I go about that?
There's the question.
Yeah, so they haven't relaxed the rules around that side of it yet. So if the portion that you bring over from Australia is not allowed to be used for a first-time purchase. It is only allowed to be used for retirement. And that's solely because of the rules they have in Australia versus New Zealand. They try and keep those, fiddlesticks. Yeah, sorry, bud.
But if you contributed from a KiwiSaver from New Zealand, that could be used towards some of that can be used for
any money that comes from New Zealand is accessible for a first-time purchase.
Okay.
Yeah. Cool.
Awesome. Thank you ever so much. Like I say, we'll put this recording on the Resourcefully blog page. Carl's still typing. Oh, it's awesome. Awesome.
You're very welcome.
Brilliant. Thank you, Sean. That was fantastic. Everybody's got Sean's email address. I'm sure he'd be more than happy for you to contact him and have some questions. And yeah, thanks once again.
No worries.
We'll hold another one next month. Yeah,
Awesome.
brilliant. Thanks, Sean.
a lot, guys.
Cheers. Thanks. Bye.